Hello everybody, what's going on? So today we are diving deep into one of the most misunderstood moments in the tech right now, Meta platform latest earnings. The headline screamed crash after the stock dropped sharply in the pre-market trading. But let me tell you something that this reaction feels like classic market over emotion. And smart investors are seeing a different picture here, like strong revenue acceleration, AI powering the core business, and a bold long term vision from one of the most successful CEOs in the history. Stick with me because we will break down the numbers, address the concern heads on, and I will share why I am more optimistic about Meta than ever I have been, and why this dip could be a gift for patient investors. So let's get right into it. First, headline numbers that the panic seller seems to have missed. The Meta delivered Q1 2026 revenue of 56.3 billion. That's a whopping 33% year over year growth. Fastest pace in the year, I would say. They crushed expectations. Advertising, their bread and butter, surged with higher impressions and better pricing, fueled by AI improvement that are making reels and videos more engaging. Even adjusting for that one time tax benefit, earnings were solid, no doubt, according to me. Operating income was strong around 22.9 billions with healthy margins. Use metrics showed some quarterly softness in daily active people due to temporary geopolitical issue in the certain region. But long-term trend for Meta families of app remains incredibly resilient with billions of users daily. This isn't a company in trouble. This is a cash machine, I would say, that reinvesting aggressively for the future. Now let's talk about the elephant in the room, which spooked the market: capital expenditure. Meta raised its 2026 capex guidance for 245 billion. Yes, that's big number. But here's why it's actually exciting rather than scary. They are pouring money into AI infrastructure, data center chips, and tools that already supercharging their advertising algorithm. Better targeting, higher engagement, more value for advertisers, unlike some peers building entirely new cloud businesses or experimental product from scratch. Meta is doubling down on integrating AI directly into what they already dominate, connecting people and monetizing attention at scale. Think about it. They are not starting from zero. They have the data, the users, and the distribution. The spending is like upgrading the engine while the car is speeding down the highway. Revenue is re-escalating precisely because of these investments, I would say. Operating cash flow remain robust, giving them plenty of firepower. Short-term margins might feel some pressure, but history shows that smart focused capex from great tech companies pay off handsomely over time. So this won't be an issue in the future. Apart from that, Meta shifting capital allocation from heavy buybacks into prior year to this build out is a sign of confidence and high return opportunity ahead, I would say. Now, let's be real for a second. No company is without risk. User growth can fluctuate with global events. Competition is social and advertising is fierce. Regulatory scrutiny is always there, and heavy spending means we need to see the return materialize. But zoom out. Mark Zuckerberg has proven time and again that he is willing to bet big and execute. From pivoting to mobile years ago, navigating scandal through COVID to leading in open AI models like Lima, this is a management team that navigate the multiple cycle successfully. The slight dip in family actives attribute partly to specific disruption, not a structural collapse in the engagement. In fact, time spent on key format like Reels is up thanks to the AI recommendations. The core ad business is firing on all cylinders. Apart from that, On a forward basis, even after the drop, Meta is screaming expensive for a high quality growth compounder with this momentum. Compare it to the broader market or other big techs. You are getting exposure to durable network effect, AI tailwinds, and a balance sheet that can weather storm. What sets Meta apart is their focus approach. While others chase multiple moonshot, Meta is embedding AI everywhere and their existing platform, improving feed ranking, ad delivery, content creation, tools for users and businesses. This lowered their risk compared to building brand new revenue stream from the scratch. They are also making strategic move in efficiency optimizing headcount in some areas while hiring AI talent. Reality Lab Metaverse AI glasses continues as longer term bet, but the core business is strong enough to fund it without panic, I would say. This isn't blind spending, it's calculated aggression in an AI arm race where Meta has unique advantage. Market loves to overreact. We have seen this move before with Meta and other great companies. Dips on capex fear user blip or macro noise create entry point for those with conviction. Long-term holders who ignore the noise in 2022 or the drawdowns have been richly rewarded. The playbook remains great with visionary leadership, strong moat, and accelerating fundamentals trend to win over year, not quarters. So, what's my bottom line here? This crash looks more like a healthy pause or even a buying opportunity for investors with 3 to 5 year horizon. Meta has the scale, the cash generation, the AI integration, and the leadership to emerge even stronger. I would say that diversification matters. Pair Meta with other quality names, maintain cash for opportunities, and stay disciplined. Look, investing isn't about chasing every headline or panicking with the crowd. It's about owning piece of incredible business, solving the real problem, connecting people, empowering creators and advertisers, and shaping the AI future. Meta has done it before with their current trajectory. And I believe the best chapter are still ahead. The temporary noise creates a clarity over those willing to look deeper. So stay patient. And if you will look the beyond immediate numbers, let's talk about what could drive Meta next leg of growth over the coming years. Artificial intelligence isn't just buzzword here. It's becoming the operating system for their entire platform. We are already seeing AI powered improvement in content recommendation that are boosting time spent on reel and video by a noticeable percentage. Imagine the scaling across billions of users. More relevant ads, higher advertiser ROI, and ultimately stronger pricing power. Meta open source approach with models like Llama position them uniquely. They are not just consuming AI, they are helping to reshape the ecosystem while keeping cost manageable through the custom infrastructure. Then there's the long term vision in augmented reality and wearable tech. While Reality Labs still report losses, increment progress on AI glasses and hardware could open entirely new computing paradigm. Think social connection, shopping work, and entertainment layered onto the real world. It's high risk, high reward, but Meta is funding it from an incredibly profitable core business rather than relying on it for near term survival. The patient capital allocation is something I really respect. We are also seeing a strong momentum in the business tool. Think AI assistance for small business running ads or enhanced creator monetization feature. These create stickiness and multiple revenue stream that compound over time. So the big question here is that how does Meta stake up against the other tech giants right now? While companies like Google, Microsoft, and Amazon are spending heavily on AI, many are building vast new cloud empires or experimental division that could cannibalize existing profit if things don't go perfectly in their favor. Meta strategy feels more contained and synergetic, supercharging the golden goose of digital advertising rather than chasing unrelated moonshots. In today's market environment, with interest rates, geopolitical tension, and AI hype cycle, Meta stand out as a company with a real earning momentum and a clear path to converging massive investment into bigger cash flow. The stock recent pullback, while disappointing in short term, has improved the risk reward profile for new money or add-ons. Forward multiple around the lows to mid 20s for this level of growth and quality, that's historically attractive. When you factor in the durability of their network effect, billions of people aren't switching away from these apps overnight. That is a good thing, I would say. So, how should you think about Meta in your own portfolio? First, position sizing is the key. Even the strongest conviction idea shouldn't dominate your portfolio. For many investors, a 5 to 10% allocation to a name like this provide excellent exposure without over concentration. So, if you are already a shareholder, this volatility is just a noise. Use it to your advantage by rebalancing or adding on weaknesses if your thesis holds. New investors consider dollar cost averaging over next few months rather than trying to catch up the absolute bottom. Diversify across other AI beneficiaries, strong cash flow compounders, and defensive sector. Always maintain dry powder for opportunities like this. One more tip, track key metrics quarterly, add revenue growth, user engagement trend, especially time spent, capex efficiency, and free cash flow generation. These will tell you if the story is playing out as expected. I know many of you are probably wondering the same thing I hear in the comment and coaching sessions. What if AI spending doesn't pay off? Management has a track record of pivoting and optimizing. They have already shown ROI through accelerating ad growth, user growth concerns, temporary regional factor, the platform, global reach, and cultural importance remain unmatched. Few are also asking about valuation too high, growth adjust valuation. At current trajectory, earning power should catch up nicely. Look, investing isn't about chasing every headline or panicking with the crowd. It's about owning piece of incredible business, solving problem and connecting people, empowering creators and advertisers and shaping AI future. Meta has done it before and with their current trajectory, I believe the best chapters are still ahead. So prepare now. With that said, thank you so much for being here. See you next one.